Nice to see you all here. My name is Katia. I'm the founder and CEO of the Fintech Times, as Mike already said. I'll let my wonderful panelists briefly introduce themselves before we start talking. Start with you.
Hi, I'm Ioana Surpateunu. I work for Citigroup. I'm a co-head of European Government Affairs, and I run the innovation strategy and advocacy around the crypto ecosystem. And that kind of explains why I'm here today.
Nance. I'm the founder, CEO of CityBlock Capital. We are a tokenized venture fund that invests in early stage blockchain infrastructure projects.
I'm Marina Titova. I'm head of advisory at NKB Group, which is a blockchain-focused investment bank.
Wonderful. So we have all the finance specialists on the panel, and the first question would be: so all of us here, we all know that tokenizing securities somewhat makes them easier and more accessible, and creates secondary market and all these wonderful things. So why, if it's so wonderful, it's not happening yet? I'll let you start, Rob.
So I think that we're one of the few projects that actually has gone through and issued a security token in this space. The reason no one's doing it is because it's almost impossible today. I'm in New York, so as a US-based person, it's really, really difficult to adhere to all the regulations that exist today. So I think regulation is tough. The ability to take regulatory legal issues and take technology and bring them together is very difficult. And then to build an asset on top of it that investors want. These are all three really big challenges in the space right now.
So it's regulation, lack of infrastructure?
Yeah, lack of infrastructure. So who's going to help you write the smart contract? How are you going to get that person to work with lawyers? I don't know if anyone here knows, but getting lawyers and tech people to work together is really, really hard when you're trying to do something that is cutting edge. So that's definitely a challenge. And then having an asset that's attractive to investors. I think everyone thinks today, because of ICOs and because of what happened with a lot of native tokens raising money, that you can take any asset, even if it's a terrible one, and crowdfund it, right, through this process. And what we've seen in this space is that on the asset side, you can't do that, right? There is no magic bullet like existed before.
With your ICO experience, do you have something to say to that?
Well, I would say all of the things that you say make sense, but I would say the biggest problem I see is the infrastructure, right? As you said, doesn't make sense for all the assets to be tokenized. The liquidity, even though it's a great benefit, it's not really needed for many asset classes. But infrastructure, I think, was the biggest laggard. We were all expecting the security tokens to really come into the space a year ago, and the exchanges were too long. The regulators perhaps were too prominent in the space, so a lot of maybe issuers and players were not really prepared to fully move in to the market. I think broadly we have all the pieces in place now, so I am quite positive for this market for the next year.
Ioana, what do institutions say?
Well, institutions are still struggling with regulatory clarity, that's for sure. Because I mean, we were discussing before, there are two channels to enter the crypto ecosystem for institutional investors and institutional money. And they are custody solutions, one, and the other one is asset tokenization. But also, as we were discussing before, there are different types of tokens. We're now talking about tokens that a tokenized version of an existing asset, but there are also the native blockchain tokens that are issued on the blockchain, traded on the blockchain, and settled on the blockchain. For tokenized assets, the settlement process still happens in the legacy system, right? And when you cross these two streams, there's also a further complication of regulation. I think institutional investors are waiting for more clarity, and I think we've passed phase one of regulatory testing of the ecosystem. We're going to be seeing 2019, probably Q1, a much more granular approach when it comes to definition of these assets. Also, when it comes to understanding the mentality behind what drives investors and also consumers to this market, and also trying to use blockchain as an enabler in conjunction with other emerging tech. So it's not just about the token. Token for me, I mean, it depends on how you look at the space. Token for me is paramount to in an incentive system in a decentralized network. This is why I think it will stay. And it's not the currency side of it that will survive, according to me at least. It's the actual utility token that provides network growth and asset, improvement of asset over time for the benefit of the network users, developers, etc. So we'll see what happens Q1 2019.
Yeah, the difference between the tokens is an entirely different discussion. But for now, so we discussed why it's not happening just yet. So what does the future hold? What needs to happen to make the digitization of assets, whatever you call it in the US, a reality?
Sure. So I think a couple things have to happen. Institutional investors have to accept it as a form of investment. So as I say with our fund, investors still get a private placement memorandum, they still get a limited partnership agreement, they still get a subscription agreement. They just also have a digital representation of that. And I think what institutions and big investors see and what scares them is what they've seen happen with cryptocurrency, where somebody has a wallet, they get stolen and they lose it. Well, that's not the case when you have a tokenized asset or a digital asset.
Is there a genuine fear that if you tokenize an asset, it's going to get lost?
Yeah, so when I talk to institutional investors, it is a fear of theirs is like, I could lose this, right? And that goes back to what you were saying about
custody
solutions. But the great thing is for security tokens, you don't have to have an elaborate custody solution because I still have a central record of who owns everything. So if someone loses it, if it's misplaced, if it's stolen, I'm not going to honor who owns it because I know who really owns it. I've got the documents. And so I can just reissue them. So there's a lot of things that on the cryptocurrency side are big issues that are not nearly as big on the security token side.
But then, can I intervene? But then the question is, why would you use a decentralized system? Because by what you've just described, using a central record,
yeah.
So it's just by combining the open rails and the centralized rails.
Well,
because
what happens today is there is a secondary market that exists for many liquid assets. It's very, very clunky. Mm-hmm. And this takes a lot of that clunkiness out of the secondary market. Again, this isn't a revolution of the financial system, it's an evolution of the current one. And so when we look at it, we see, listen, there's a way to evolve, make secondary transactions much more transparent, make them work a lot better, allow someone to sell an asset without going back to the issuer. These are all great improvements over the current system.
But I think also to add to your point, right, we have to also distinguish between the types of security tokens. The ones that you're talking about is more traditional financial systems that can be tokenized, and there are certain benefits to that. But there could be certain, say, on-chain type tokens that are also security tokens, say maybe staking, revenue tokenized, and things like that. And those do not necessarily have to go through, say, traditional route settlements. They could be fully decentralized.
For now, yes.
As well.
Yeah. But when they scale, they might. That's because.
So what's so let's not go into the tokens which are not digitized securities, right? For now, we're discussing that. Okay. So what do we need to do?
Those are the cool ones.
I know, sorry about that. So which steps do we need to take? So what's the first thing we need to solve in order to make it to take it mainstream?
For institutional people, it's regulatory clarity and regulatory collaboration, because once they get the green light from the regulators that it's okay to step in this space and start to be creative, I think.
Then they will start to get
I assume so.
To get curious, okay.
I would say now already you can place the security tokens, maybe not in all jurisdictions, but where there is, say, clear capacity for private placement, or maybe some clarity on digital assets, say, as in Malta. You can already do it, say, jurisdiction by jurisdiction, those offerings, and they have been taking place for a couple of years ago, very, very slowly. I think it's more to do with exchanges, which are only coming online now.
So the secondary markets.
Yes.
That has to be created.
And then also custody. Again, as we have said, the traditional institutional investors would want, say, SEC-registered custodians or that type of custodians to be able to invest. You know, with in our practice, the investor base we have for say, utility-type offerings, these are VC-type mandate blockchain investors. They are not necessarily looking at tokenization of art or real estate. But to bring more, say, traditional investors who would look at those, they need to have custody solved, right? And again, we do a lot of work to bring those investors into that asset class. But again, the things like custody and exchanges are really only up and coming, the past few months.
Right. But so in your experience, you managed to tokenize some sort of asset, right?
Yeah, venture fund. Yeah, or venture fund.
Were you the first ones?
No, I mean, so Blockchain Capital did it. Spice VC has done it. A couple people have done it. I think the difference is, we were the first out of the gate to issue legally in the U.S., right? I think the other people that have had to come back and retrace their steps a little bit, and that's because certainly of regulatory uncertainty that's existed today and the way that the technology was handled. So the way that this gets mainstream adoption is by, innovation always comes from the fringe, right? So Amazon reinvented retail, not Walmart, right? The big players have very little incentive. So the big funds in the space, so let's think about like Carlyle, KKR, they're not going to be the first to tokenize. It's going to take a lot of fringe funds, smaller funds like myself, to bring into the space and get acceptance from investors before they do. I actually think the way that this adoption is going to be driven is by the actual LPs or the investors themselves. So institutions are going to start demanding that funds become tokenized, and they're going to demand it because they're going to want liquidity. If you look at Harvard Endowment, for example, in 2008, right, their liquid assets became 90% of their overall portfolio. And so they had to sell some of these assets at 50 cents on the dollar. And that's because in these illiquid asset classes, they didn't have the ability to sell them as the market was going down. They had to hold them. So what's going to happen is once the Harvard Endowment, the Yales of the world, which, by the way, just invested in Bitcoin and crypto for the first time, once they start seeing the upside of doing this, that's going to drive a lot of adoption and will accelerate investment into the space to build it out. So you have to look at secondary trading. There's really no one doing it. I think there's been a few trades on a couple of like Open Finance Network, I think did one. AirSwap, I think did one. So these are all the type of companies that are going to have to be built out. And liquidity that's going to exist is not going to be liquidity like exists in the crypto space or exists in the publicly traded markets today.
I just wanted to comment when you mentioned crypto, exchanges, right? They're going to be the build out of the secondary market infrastructure. It's important to, I go back to regulation, I know I'm boring, but it's important to have them regulated because most of the hacks happened on these exchanges, not on the blockchain itself, which so far has not been hacked, but on the exchanges. And then going back to your central record, that's also a honeypot for hackers as well. Because it's one of the ideas of having a DLT or distributed technologies to disperse risk, right? Sure. So that's also a factor to keep in mind.
Sure, and I think there'll be evolutions of the technology, right? And it could move in that direction. I think at first that's not where it's going to go. I mean, companies themselves are centralized. We don't live in an age where there's decentralized companies, so it's going to be really hard to decentralize a lot of the storage and record keeping that exists. If you look at how stocks traded today, especially in the US, no one owns stock. Like, you cannot get a stock certificate of Apple with your name on it. It's impossible. It's because it's all in one company's name. And it's crazy to think about. In 2018, you can't do that. You cannot have a peer-to-peer transaction, right? And we're moving toward that. It's just going to take several steps to get there.
Fair enough. Do we have more time for one more question? No. Fair enough. Okay, so probably you have some questions to ask our panelists. They will be around for some drinks afterwards, so you can approach them then. Thank you.